Welcome back with WeMasterTrade fam. It's me Scarlett here and I'm beyond excited to be here with you today for another incredible live session. Whether you've been with us for a while or this is your first time joining, buckle up because we got a jam-packed full session full of insights, strategies, and the kind of tips that will take your trading game to the whole new level. Who's ready to crush it today? So let's get some love in the chat. Drop your favorite emoji and hit that like button. And let me see where you're turning from. Whether it's New York, Tokyo, London, or anywhere in between, we want to hear from you. The WeMasterTrade community is global, and today we're all in this together. And hey, if you're not subscribed yet, you know what to do. Smart that subscribe button and stay in the loop for all the tips and tricks that will help you level up. Alright, I love the energy already. We got traders tuning in from all over the world, and it's awesome to see everyone coming together to share, learn, and grow. Let's keep that momentum going because today's live session is going to be next level. We got some special guests who are here to share their stories, strategies, and help them rise into the top of their game. Trust me, you don't want to miss a single word. First up, I have the honor to introducing Ralph, an absolute beast in Forex market. Ralph has been mastering Forex trading for over 2 years and a half, and he's here to share some seriously valuable insights with all of you. Ralph, how is it going today?
Hey Scarlett, I'm feeling fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful approaches I've recently adopted. I'm eager to delve into some of the strategies I've been applying in the Forex market.
I love that energy, Ralph. I know our audience is pumped to hear all about your Forex journey. But before we get into that, let's not forget about our next guest, Helen. Helen's been dominating the fund trading scene, especially in the high-stakes world of crypto and stocks. Helen, how's it going?
Hi Scarlett, I'm equally excited to be here. This session always offers a great topic for discussions, and today I'm thrilled to share some of the strategies that I have adapted for me in fund trading. It's going to be an engaging session.
That's what we love to hear. So, for everyone watching, make sure you got your notepad ready because Ralph and Helen are about to drop some serious knowledge bombs. We'll be diving deep into their experiences, challenges, and the strategies that have helped them thrive in the past-paced world of trading. Alright, Ralph, let's kick things off with you. You've been trading Forex for over a year and a half now, and I know the Forex market can be a little bit of roller coaster. Can you tell us how you got your start in Forex trading and what led you choose WeMasterTrade as your platform?
Certainly, Scarlett, I began Forex trading about 2 years ago, and what captivated me initially was the market vibrancy and capital activity. The Forex market is exceptionally dynamic, and I was attracted to the concept that there is always potential for success regardless of the circumstances. When I first discovered WeMasterTrade, it immediately resonated with as the perfect match. The resources they provide, including sophisticated technical analysis and access to real-time data, truly impressed me. However, it was the community aspect that clinched it for me. WeMasterTrade places a strong emphasis on aiding traders' success by offering essential tools and support to advance regardless of your starting point.
That's fantastic, Ralph. It sounds like WeMasterTrade has really helped you elevate your game. Now, Forex is known for its volatility, and sometimes that can make or break a trader. How do you handle the ups and downs of the market without letting the pressure get to you?
Great questions. Volatility can be challenging, but it's also where the real opportunities are. The key is having a solid risk management plan, and I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools help me do that. Their real-time alerts and customizable risk parameters allow me to react quickly but with control. When the markets move fast, you have to stay calm, trust your strategy, and not let emotion take over. And for me, that's where WeMasterTrade feature really shine.
That's some seriously valuable insight, Raf. Managing risk and staying cool under pressure is definitely key in forex trading. Now, Helen, let's switch gears to fund trading. You've been crushing it for nearly 2 years, specializing in long-term strategies. Can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely, Scarlett. Fund trading revolves around strategic long-term growth. It's not about seeking quick win, but constructing a portfolio that can steadily expand over time. Actually, this question with fund trading is you need to consider both short-term and long-term perspective. Careful risk management is crucial, while subsequently keep an eye out for emerging opportunities. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to make well-informed decisions that align my long-term strategy, even when the market presents unexpected challenges.
I love that. Fund trading definitely seems like it requires a lot of patience and foresight. Helen, how do you stay focused on a bigger picture, especially when the market gets rocky?
Patience is paramount in fund trading. The market experiences fluctuations, but short-term up and down shouldn't dictate your long-term strategy. A crucial lesson I learned is to maintain emotional detachment. Don't get overexcited when things are going well, and don't panic when the market dips. We want to try risk management to assist me in staying disciplined even during volatility. I can set up precise risk parameter and have a peace of mind knowing that I'm not overexposed even when the markets behave.
That's such solid advice. Keeping your emotions in check is definitely a big part of being successful in trading. You both have shared some serious gems so far, but let's talk about the tools that help you get to where you are today. Raf, can you share one specific feature on WeMasterTrade that has been a game changer for you in Forex?
Definitely, a tool I absolutely rely on is the account insight features. It offers up to the minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make better informed choices. Whether I'm pinpointing the best time to enter the market or deciphering market trends, this tool gives me an edge. It has enabled me to spot opportunities that I might not have noticed otherwise.
That sounds like a total game changer. Having a real-time insight is crucial, especially when you need to make quick decisions. Helen, how about you? What's been your go-to tool in fund trading?
For me, it's all about the risk management tool. They allow me to customize the amount of risk I'm willing to take on any trade. This has been key for me, especially in a volatile markets like crypto. WeMasterTrade helped me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded even when the market is going wide.
Risk management, so important, especially in today's fast-moving markets. Whether you're in Forex or fund trading, having the right tools make the world of difference. I hope everyone taking notes because Rav and Helen are driving some serious broad-level insights today. Alright, trader, we're kicking things off a notch because it's time to dive into one of the most powerful features here at WeMasterTrade, the package comparison. Whether you're a fast-paced newbie eager to get your feet wet or a seasoned pro looking to scale your game to a new heights, this segment is for you. This is where you find the perfect trading package to match your goals and take your trading from good to great. Now, let's be clear, here at WeMasterTrade, we know that there is no one-size-fits-all in trading. Every trader is unique with different styles, risk tolerances, and strategies. That's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. Whether you're aiming for high risk and high rewards or you prefer steady, methodical approach, there's something here for you. And to break it all down, I got the awesome Raf and Helen, two of WeMasterTrade trainers. They both worked closely with these packages and are here to give us the inside scoop on how to leverage each one to its full potential. So drop a hit if you're ready to find out which package will take your trading game to the next level. Alright, let's jump in, Rev. You've been with WeMasterTrade for a while now, and you've seen firsthand how these packages are elevate a trader's experience. Can you kick things off by walking us through how both new and experienced traders can benefit from the package comparison? Why is this such a game-changing feature in WeMasterTrade experience?
Absolutely, Scarlett. I really enjoy discussing these packages because it's where traders can truly customize their experience. The package comparison feature simplifies the process for traders to understand precisely what they are getting. When you visit the website, there's a detailed comparative overview of each package that includes information like the initial balance, profit targets, loss limits, and more. All the essential details are presented in a straightforward, easy-to-navigate table. It's on structure to assist traders in selecting the best tool for their success. Let's talk about the standard package, one of the most popular options. This one is great for traders who got some experience and are ready to level up. You start with an initial balance of up to $200,000, which gives you plenty of room to trade confidently and make strategic moves. The profit target is set at 6%, which is perfect for traders aiming for steady, sustainable growth. And the daily loss cap is 4%, so you got enough brain room to ride down market swing without stressing too much. It's an awesome balance between opportunity and security.
Wow, that sounds like a perfect stepping stone for traders looking to level up without jumping into deep too quickly. A $200,000 balance and a solid 6% profit target give you a tons of flexibility to build momentum. But for those who are looking for something a bit more thrilling, let's talk about a 5-10-10 package. Rev, I hear this one a favorite for high-risk, high-reward traders. What makes a 5-10-10 such a standout?
The 5-10-10 package, now we're talking big price. Like the standard package, you start with $200,000, but this package is for traders who are ready to take on bigger risks for bigger rewards. The daily loss cap is 5%, giving you more flexibility in how you handle the market. But here's the kicker, the profit target jumps to 10%. This is perfect for traders who have confidence in their strategies and are looking to make those major gains. It's all about having a higher tolerance for risk in exchange for bigger payouts.
Now that's what I'm talking about. A 5% loss gap and a 10% profit target. That's definitely for traders who aren't afraid to go big and swing for the fences. But what if someone looking for something more relaxed? Maybe they want something simpler without all the pressures of hitting specific profit targets. Helen, I heard about a 5-10-0 package. Can you break it down for us?
Absolutely. The 5-10-0 package is ideal for traders who want a straightforward, no-nonsense approach. You start with 100,000 balance, but here's the cool part: there is no profit targets. You can trade freely without the stress of hitting specific percentages. It shows you the market in your strategies. The daily loss cap stays at 5%, giving you some structure, but the beauty here is that it allows traders to focus on consistency without worrying about specific growth.
Wow, that sounds like a dream for traders who just want to trade without all the restrictions. Total freedom, no pressure, just you and the market. Now, Helen, what about those traders who want a bit more control over the risk management but still want to play in the high-stake arena? What can you tell us about a 5-10-10 no PC package?
Alright, the 5-10-10 no PC package is perfect for traders who want more control over their trades. You still got the 200,000 starting balance and the 5% daily loss cap, but the flexibility is the real selling point here. This package allows you to track and adjust your trading parameters to match your style and risk management preferences. Whether you're reacting to market changes or want to experiment the different strategies, this package gives you the freedom to adapt without losing the steadiness of risk management.
Flexibility and control in volatile market, that's huge. I love how these packages are giving traders more way to adapt and grow. Now we cover a lot, but I've been hearing whisper about something really special, the custom package. Ralph, can you tell us what makes this one so exciting?
Okay, the custom package is where things get really exciting. This is for traders who want it on full control, full customization, and a massive starting balance. You get a jaw dropping for $100,000 initial balance. Yes, for $100,000. But that's just the beginning. The real beauty is that you can customize everything. Time loss limit, overall loss limit, and even your profit target. It's perfect for traders who know exactly what they are doing and want to craft a trading experience that matches their exact needs. It's the ultimate in freedom and control.
For $100,000 starting balance and the ability to customize your entire trading experience, that's next level trading. Whether you're a risk taker or a methodical trader, the custom package sounds like the ultimate playground for those who want to take their trading to the stratosphere. Alright traders, let's quickly recap where you're just starting with the standard package, going for bigger rewards with the 5-10-10 package, enjoying full freedom with 5-10-0, taking control with 5-10-10 no BC, or customizing everything in the custom package. WeMasterTrade has the perfect option for you. The only question is which one is calling your name. Here, head over to the package comparison session on our website right now and check it out for yourself. We got packages designed to fit every trader, no matter you are in your journey. Let us know in the chat which package speaks to you, and our team is ready to help you get started. The future of trading is in your hand, and let's make it happen. Alright traders, this is where the magic happens. We'll talk about the packages and how you can jumpstart your trading journey with WeMasterTrade. But let's be real, success in trading isn't just about the package you choose. It's also about understanding and sticking to the rules. The conditions we set at WeMasterTrade are designed to not only keep you safe, but also have you grow and take your strategies to the next level. Now, whether you're just getting started or you've been trading for years, these conditions will act as your roadmap. So let's dive into the rules and that define our trading environment, because if you understand the rules, you can master the game. First off the list, and arguably one of the most important, the daily loss limit. Helen, you've been through it all, the highs and lows. Can you kick things up by explaining to everyone how this daily loss limit works and why it's so crucial for managing risk?
Absolutely, Scarlett. The daily loss limit is one of the most operation any trader can employ. It serves as a daily circuit breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There is no limit to how much you can lose in a single day of trading, and it's determined by the greater of two values, your account balance and your equity at the beginning of the day. Let me break down with an example so everyone understands it clearly. For the first example, let's say you got a balance of 105,000, but due to some open trades, your equity, including floating profits and loss, is 107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to the 4,000. And if your equity falls below 103,000, you're done trading for the day. So the next example, on the flip side, if your balance is 100,000 and your equity is 99,000, the same 4% loss limit would mean your account could be liquidated if your equity is below the 96,000. The point is, the daily loss limit is there to make sure the bad day doesn't whip you out completely. It's about protecting your account and giving you a chance to regroup and come back stronger the next day.
Got it. So it's like an insurance policy for your trading day. You hit that limit and boom, you're out before things get out of hand. But what happens if trader accidentally crosses that line? Can they keep trading?
Great question, Scarlett. And no, if you breach the daily loss limit, your account is automatically liquidated. All your open position will be closed and you won't be able to trade again, or unless you buy a new trading package. So here's the thing, This liquidation is automatic and immediate. It's designed that way to prevent further losses. But here's a word of caution. Market fluctuation can sometimes cause you to lose a bit more than the limit, depending on how fast the market is moving.
Oh, so it's a hard stop, definitely something traders should keep an eye on to avoid. Now that we understand the daily loss limit is and what happens when it's hit, the next question is how to avoid hitting that limit in the first place. Helen, you've been in the trading strategies for years. Can you share some practical strategies that traders can use to stay within their daily loss limit? We're all ears.
You got it, Scarlett. Staying within the daily loss limit is all about being disciplined and following a solid risk management plan. Here are the few key strategies that have worked wonderful for me and countless other traders. First, and I can stress that always use a stop loss. I know it sounds simple, but it's absolutely critical. The stop loss ensures that if the market moves against you, you're out of a trade. Before the thing get out of hand, think of it as your safety net.
That's like setting up a guardrail on a mountain road, right? It's there to stop you before you go off the cliff.
Exactly, Scarlett, is that extra layer of protection. Now the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you are still far from hitting your daily loss limit and you can keep trading without any major setback.
So it's like building your defense. You don't put everything on one plate, right? You spread out the risk. Makes sense, but what about those moments when traders feel tempted to trade after their losses? You're not trying to get it all back in one trade.
Oh, that's a big one, Scarlett. Chasing losses is one of the biggest mistakes traders make, especially newer ones. This brings me to my third strategy: don't chase losses. If you are having a tough day, take a step back. The market will always be there tomorrow, and if you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that lead to even bigger losses. And before you know it, you hit that daily loss limit and you are out for the day.
So true, it's like trying to sprint when you already won it. You are more likely to make a mistake. Now Helen, this strategy sounds spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them falling into the emotional trap of chasing losses?
It's all about mindset, Scarlett. Trading each other as a mental game as it's a number game. You got to stay calm and focused. One choice is to always have a trading plan before you even play a trade. That's why when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop, take a break, step away from the screen and reset your mindset.
Thank you, Helen, for those incredible tips on managing the loss. Now, let's shift our focus to another critical element of risk management, the maximum loss limit. This limit is like your long-term safety net, ensuring that you don't deplete your account over time. Unlike the daily loss limit, which resets at the end of each day, the maximum loss limit is cumulative. When you reach it, your account will be locked and your trades will be closed. To dive deeper into this, let's discuss how the maximum loss limit works and how it's calculated and why it's essential for traders at every level. Whether you're a new trader looking to minimize risk or an experienced trader scaling your strategies, this limit ensures that you don't go beyond a point of no return. Helen, I know you got some great insights into the mechanic of the maximum loss limit. Could you walk us through how this rule works and what traders need to keep in mind as they plan their trading strategies?
Of course, Scarlett, the maximum loss limit is a vital rule that's often overlooked but extremely important. Essentially, it's there to prevent traders from experiencing catastrophic losses by capping how much you can lose throughout the life of your trading account. Let's break it down. The maximum loss limit ensures your account equity never falls below 94% of its initial balance. So, if you start with a balance of the 15,000, your account will be closed when your equity fall down to the 47,000. That's a total allowable loss of the 3,000. However, it's not about bad news. If you start making profit, the limits adapt, giving you more breathing room as your equity grows. For example, if your account balance increases to the 52,000, you now make the 2,000 in profit. Your new maximum loss would then slow you to go up to the 5,000, as you essentially locking in your gas. The maximum loss limits act as a long-term safeguard. It is designed not only to protect your account but also to encourage disciplined trading by setting boundaries. The goal is to ensure you don't dig yourself into the hole that's too deep to recover from. Here are some few specific examples. For the first case, let's say your account balance starts with 50,000, but your equity dropped to the 49,000 due to some market losses. You allow to lose another 2,000 before your account hit that critical 47,000 threshold and it automatically closed. The next case, now if you're doing well and your equity rise to the 51,000, you got some extra cushion. At this point, you're allowed to lose up to the 4,000 before your account hits the same 47,000 limits. To figure out where you stand, the maximum loss limit is calculated by adding the sum of your closed position and factoring in any open position that are still running. Your trading dashboard will show two key metrics: mark permitted losses, which is how much you allow to lose overall, and remaining loss, which is the loss left before your account is closed. Now, what happens if you hit that limit? Well, unfortunately, if your equity hits the maximum loss limit, the system will automatically close your account for the day. All your open positions will be liquidated. Whether they are profitable or not, you will be unable to trade for the rest of the day. To resume trading, you will need to purchase a new trading package.
Thanks, Helen. That definitely helps clarify the nuts and bolts of the maximum loss limit. It's kind of like a safety buffer, isn't it? It's there to keep you from spiraling out of control, especially when the markets get volatile. Now, I imagine this rule impacts different traders in different ways. Whether you're a cautious trader who keeps their risk low or a more aggressive trader trying to maximize profits, this limit is one of those things you can't afford to ignore. Let's bring Ralph, our risk management expert. Ralph, what do you think are the most common mistakes traders make when it comes to managing their maximum loss limit? And more importantly, what strategies can traders implement to ensure that they never get too close to it?
Great question, Scarlett. You are absolutely right. No matter what type of trader you are, ignoring the maximum loss limit can be costly. In fact, it's one of those things that sneak up on traders who aren't paying attention to the long-term pictures. And I would say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. Here are some key strategies I recommend to stay well within your maximum loss limit. This is your first line of defense: setting stop loss order on every trade, deciding in advance how much you are willing to lose on a particular trade. The system will automatically close your trade if it hits that number, which protects you from letting a losing trade get out-pumped. For example, if you are only willing to lose $500 on a particular trade, you set that as your stop loss and you won't have to worry about it spiraling.
I love that. It's like putting safety powder on each trade. Once you're locked in that stop loss, you're out of your hands.
Exactly, Scarlett. It's all about discipline. And this is a big one. Often traders, especially new ones, get carried away by putting too much capital into a single trade. But when you risk too much, you also risk losing a larger percentage of your account if the trade goes south. A good rule of thumb is to risk no more than 1 to 2% of your total account balance on any single trade. For example, if your account balance is $50,000, you should only risk about $500 to $1,000 per trade. This keeps your potential losses manageable and well within your limit.
That makes total sense. You're not putting all your eggs in one basket, and it gives you more room to breathe, right?
Exactly, it's all about spreading the risk so you don't take too big of a hit on any one trade. The third one is monitor your account equity regularly. This may sound basic, but it's incredibly important to keep an eye on your account equity throughout the day. It's easy to get caught up in the market's highs and lows, but you should always be aware of how close you are to your maximum loss limit. Your dashboard makes it easy to check your remaining loss, so use it. If you see that you are getting close to the limit, it's time to take a step back and re-evaluate your strategies.
It's almost like watching a fuel gauge. You don't want to be driving on fumes without knowing it.
Exactly, and no one wants to get stuck on the side of the road. Having a well thought out trading plans is one of the most powerful tools in a trader arsenal. This plan should outline not only your profit goal, but also your risk management rule. For example, if you have a few losing trades in a row, doesn't your plan tell you to take a break, reset, or change your strategy? The idea is to have a preset series of rules so you don't make impulsive decisions in the heat of the moment.
It's like having a roadmap, right? You know where you're going. You have contingency plans for when things don't go as expected.
Exactly, the market can be unpredictable, but a solid plan keeps you grounded. Even the best plan needs to be reviewed and tweaked from time to time. If you find that you're approaching your maximum loss limit too often, it may be a sign that your risk management strategy needs adjusting. Maybe you need to tighten your stop loss set or reduce your trade size. The key is to stay flexible and adapt to changing market conditions while always keeping your risk in check.
That's great advice, Helen, and it's all about constant improvement. You can't just set it and forget it. You got to be ready to adjust based on your results and the market.
Absolutely, trading is dynamic and your strategy should be too.
Thank you for the fantastic breakdown of the maximum loss limit, Rev and Helen, and next up we will have a little short break.
Copy Trade.
Topic: the profit consistency rule. This rule is critical for ensuring long-term sustainable success in trading, as it helps measure and maintain consistency in your profits. Now, to give a clearer picture of how profit consistency rule works and why it's important, let's turn to Ralph. Ralph, can you break down the rules for us? How is it calculated and why is it important for traders to focus on their consistency rather than just aiming for big wins?
Of course, Scarlett, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making big gains on one or two good days, it's about being consistent day in and day out. So here's how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total on your profits and losses over a given period, usually a month or a quarter. You then express the result as a percentage. Let's go through an example. Say your best day brought in $200 in profit, but over the months your total profits and losses add up to $410. In that case, your profit consistency ratio would be about 48.7%. This ratio shows how much of your performance comes from one standout day. Ideally, you want this percentage to be lower, under 20%, because that means your profits are more evenly spread out across all your trading days. Now, why is this important? A low profit consistency ratio indicates that you are not just relying on a couple of big wins to stay profitable. Instead, you are showing that your strategy works consistently over time, even on those days when the market isn't giving you big wins. This kind of consistency is the hallmark of a successful long-term trader.
That's a great explanation, Ralph. So just to clarify, a lower ratio means you're more likely to make steady gain rather than being overly dependent on a few good days, right?
Exactly, Scarlett. When you are too reliant on just a few big wins, it often means that your strategy is risky or inconsistent. You could go through long stretches where you are not making much money or even losing it. But if your profit consistency ratio is low, it shows that your performance is smoother and that your trading is more predictable and stable over time.
That's incredibly insightful, and it's still quite a critical metric for any trader who's serious about long-term success, right?
Exactly. Consistency is the key to sustainable profitability. Big wins are great, but if they are followed by big losses or long periods of break-even trading, it's hard to maintain momentum. With the profit consistency rule, traders can keep an eye on how reliable their strategy is over time.
Awesome! Now we got a solid understanding of what the profit consistency rule is, and let's dig into some practical strategies to help traders maintain a low ratio, ideally under 20%. Helen, I know you got some great tips for us. Can you walk us through some techniques that traders can use to stay consistent and ensure their ratio stay in check?
Absolutely, Scarlett, the profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those array big wins. One of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investment across different markets, asset classes, or even trading strategy. If you only trade one market, say forex or stock, you risk being too reliant on that market performance. By diversifying, you reduce the impact of any single loss and create more stability on your overall performance.
That makes a lot of sense. So if I'm only trading in, let's say, the US stock market, a bad week could really hit my profit consistency hard. But by adding trades in, for example, commodities or forex, I could balance out some of that risk, right?
Exactly, Scarlett. It's all about the balance. When one market isn't performing well, another markets might doing better. This way, your overall performance stays smoother and you are not relying on one or two trades to pull you through. Next up is position sizing. One of the biggest mistakes traders make is over leveraging. Taking on positions that are too liquidity to their account balance. For example, if you have a 10,000 account, putting a 5,000 into a single trade is risky because if that trade goes south, you could lose a significant portion of your capital. Instead, aim to keep your position size small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and help ensure that losses don't overwhelm your profit.
Right, so it's not just about picking the right trades, but also making sure you're not putting too much of your capital at risk on any single trade. Smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and risk settling. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to get caught up in the emotion of trading, whether that's the excitement of potential win or the party of a sudden loss. A solid plan outlines exactly when you enter a trade, you will exit, and how much risk you are willing to take. Having these rules in place keep your grounded and help ensure that your trading decisions are consistent, which in turn help your profit consistency ratio in check.
That's a really good point. A lot of traders, especially new ones, probably jump into trades without a solid plan and end up making emotional decisions, right?
Absolutely, Scarlett. It's so easy to get emotional in the heat of the moment. But if you have a plan, it's much easier to stay disciplined and avoid impulsive trade that could hurt your performance. This brings us to stop loss order. A stop loss is an automatic asset that you set up to close a trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. By using stop loss orders, you can avoid the catastrophic losses that can throw up your profit consistency.
I like the idea of using stop loss orders. It sounds like a way to take the emotion out of decisions making process.
Exactly, it's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you stick your plan and avoid large, unexpected losses. Another important strategy is regularly review your performance. Just because you set up a solid plan and strategy doesn't mean you should put everything on autopilot. It's crucial to check your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So it's like performing maintenance on your trading strategy, always looking for ways to optimize and improve.
Exactly, just like a car needs regular tune-ups, your trading plans too. Continuous improvement is key to keeping your profit steady. Finally, and this is a big one, avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotion can lead to poor decision making. If you stick to your strategies and avoid chasing losses or getting overly excited after a good day, you will see much more consistent results.
That's such an important point. Staying calm and disciplined even when the market is going crazy is easier said than done, right?
It's definitely take practice, but staying level-headed is crucial for long-term success. If you can control your emotion and stick to your plan, you will be far more likely to maintain consistent profits.
Alright traders, let's dive into a crucial aspect of effective trading, the risk consistency rule. This rule is key to maintaining both stability and long-term profitability in your trading account. Helen, Ralph, I know you got a great way of explaining it. Can you walk us through what the risk consistency rule is and why it's so important for traders to follow?
Sure thing, Scarlett. The risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents large swings in your equity and helps mitigate the risk of significant losses due to sudden market movement or unexpected events. Let's break it down a little more. First of all, the maximum risk per trade idea. You shouldn't risk more than 2% of your initial balance on any single trade idea. This includes any floating losses, so you need to factor in on potential exposures. The second one is trade idea definition. Multiple trades on the same assets in the same direction are considered a single trade idea. On the other hand, trades on different assets or in opposite directions are treated as separate ideas. For example, if you open several positions on gold buy, they would count it as one trade idea and the combined risk must remain under 2%. But if you have a gold buy and a GBY sell, they treat it as two separate ideas, each with their own 2% risk limit. Following these rules smooths out your equity curve, encourages disciplined trading, and most importantly, reduces the chances of massive losses.
Thanks, Rad. That's really helpful overview. Now let me throw this back to our audience for a second. Traders, have any of you ever found it tricky to stick to the risk consistency rule? How does it feel to have those risk limits in place? Does it ever get in the way of your trading strategy?
Absolutely, Scarlett. The main points to remember about the risk consistency rule are risk per trade idea. Stick to risking no more than 2% of your initial account balance on any single trade idea. This keeps potential losses manageable and ensure you don't risk too much on any one trade. The next one is single trade idea. If you are opening multiple trades on the same assets and in the same direction, they count as one trade idea, so your combined risk must stay within that 2%. The last one is several trade ideas. Trades on different assets or in different directions are considered separate ideas. Each of these can have its own 2% risk, but be mindful to keep track of them. So why does this matter? First of all, it stabilizes your equity curve by preventing huge swings in your account balance, and it promotes discipline by encouraging traders to think more carefully about their risk. And lastly, most importantly, it reduces the risk of major losses that can really hurt your overall performance. So in short, adhering to this rule helps keep your trading account safer and support long-term success.
Right, Raf. Now I know some of you might be wondering how to make sure you actually stick to this rule. So let's shift gears and get into some practical strategy for making it easier to follow. Helen, could you share a few tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
Of course, Scarlett, sticking to the risk consistency rule takes some planning and discipline, but it's totally doable with the right strategy in play. Here are some of the few key tips. First and foremost, clearly set your maximum risk per trade idea to stay within the 2% limit. You can use risk management tool or calculator to help with this. Most platforms have a built-in tool that allows you to automate risk limits.
That's good points. Having that automation takes a lot of pressure off, right? No need to constantly double check. Your platform does the heavy lifting.
Exactly. It makes it so much easier to stick to your risk limits when the platform handling the number for you. It's also important to keep track the total risk across multiple trades on the same asset. For instance, if you open several positions on gold buy, make sure the combined risk for all of trades doesn't exceed 2%. This is where the traders sometimes deliver. They open multiple positions without realizing that combined they're risking more than they intended.
So even though the trades are technically separate, if they are on the same assets, you got to look at them as one entirety, right?
Exactly, Scarlett. Treat them as one idea because they are exposed to the same market movement. Speaking of different trades, it's equally important to trade on different assets or in opposite directions as separate ideas. This way you can manage a trade risk individually without exceeding the 2% rule on any single trade.
Right, so you could be running a gold buy and a GBP GBY sell at the same time without violating the rule, as long as you manage the risk for each one separately.
Exactly. Just make sure you keep an eye on risk for each idea individually. I recommend using risk management feature that many trading platforms offer, like automatic position sizing or stop loss orders. These tools can help control your exposure and prevent you from overextending your risk.
And I imagine these tools will help prevent the moments where you're tempted to take on too much risk on the heat of the moment, right?
Absolutely, it takes the emotions out of the equation and help you stay disciplined. And lastly, make it a habit to regularly review your trading activity. This is something a lot of traders neglect. Reviewing your trades help ensure that your risk per trade ideally remain within the set limit. And if you notice any pattern or area where you take on too much risk, you can adjust your strategy to stay compliant.
It sounds like regular check-ins are crucial to spotting potential issues before they become big problems.
Exactly, Scarlett. It's all about staying proactive.
Great tips, Helen. Now I'd like to move on to an important update regarding how we handle risk consistency rule violations. If an account is terminated due to breaking this rule for the first time, except for those on no BC package, there are now two options available for customers. First, they can choose to reset their account to its initial balance, which gives them a fresh start. Alternatively, they can choose to reactivate their current account, keeping the existing balance and setting intact. Alright, I think that's covered it. Let's make sure we're applying this risk management strategy and taking advantage of the new options available for account management. Thanks, Rav and Helen, for your insights. And next, we will move to our next important products, that is our challenge package. So, Rav, can you break it down the challenge package?
Absolutely, Scarlett. This challenge is a game changer for traders who want to hone their skills and start trading with real funds. It's designed to be accessible for everyone, no matter their experience level. So if you are tuning in today, you are about to learn how you can take your trading to the next level. Let's dive into the detail and show you how this program works step by step.
And the WeMasterTrade challenge is designed to help traders hone their skills and get funded without risk their own money. Participants start by trading with virtual funds on the MT5 platform. Rav, can you share more details about the account options available?
Of course, Scarlett, one of the best things about this program is its flexibility. You can select an account size that suits your preference, ranging from $5,000 to $100,000. This range ensures that whether you are testing our strategy or aiming for higher stake, there's an option for you. And don't forget, as you progress, there are opportunities to scale up your account size. Plus, these accounts are designed to mimic real-world conditions, giving you a realistic trading experience from the start.
That's right, and the structure of challenge make it all more exciting. There are two ways to complete. Point one focus on consistency and follow risk management rule. We are key trait of a successful trader. It's about providing you can trade profitable while adhering to set parameters such as maximum daily drawal and overall loss limit. This way emphasize discipline, which is essential for long-term success.
And phase 2 is where things get even more exciting. In this phase, you demonstrate your ability to generate profits while still maintaining the disciplined habit you developed. The criteria are slightly more relaxed compared to phase 1, but the focus on steady, consistent gain remains. It's all about showing that you can handle the pressure of trading while staying within professional standards.
And here the result. Once you successfully complete both phases, you granted real funding to trade with. The profit sharing model is incredibly generous. You earn the 90% of the profit you generate. Imagine turning your trading skill into real, sustainable earning with such a high profit share. It's a level of trust and opportunity that's hard to find elsewhere.
Another thing to note is that WeMasterTrade Challenge is designed to teach you valuable lessons about risk management and trading psychology. By participating, you're not just earning an opportunity to trade with real funds, you're also building a strong foundation for a successful trading career. It's a win-win for traders at every level. Let's talk about the standout features that make the challenge so unique. Raf, can you highlight the variety of instruments available?
Of course, one of the biggest advantages in the diversity of trading instruments. You have access to over 300 symbols, including forex, stock, and cryptocurrencies. This variety allows you to test and apply different strategies across multiple markets. It's perfect for traders who want to diversify their portfolios and gain experience in different market conditions.
And speaking of strategy, the challenge supports unlimited approaches. Whether you prefer scalping, automatic trading, new trading, or even copy trading, the platform accommodates it all. The flexibility means you can stick your strength while exploring new methods if you wish.
Another incredible feature is that WeMasterTrade covers all trading losses. This removes a huge barrier for any traders, allowing them to focus on learning and improving without the fear of losing their own capital. Plus, WeMasterTrade copies your trades to live markets, ensuring that your skills and strategies are put to real-world use.
And for those of you who want to skip the step and jump straight into trading with real funds, WeMasterTrade offers instant funding products. These are designed for experienced traders who are confident in their abilities and ready to start earning immediately. It's a fantastic option for those who want to fast-track their trading journey.
Thank you, Raf and Helen, for the brief explanation about the challenge package. And next, I will move on to the news calendar.
So, the first event for today's news calendar is the 10-year bond auctions. The auction results show a yield of 4.44%, slightly higher than the previous figures, which is 4.31%, with a bid-to-cover ratio of 2.7 compared to the previous 2.6. About the interpretations, a higher yield means investor demand more return, possibly due to inflation risk or interest rate expectation. The solid bid-to-cover ratio suggests your demand for U.S. debt seen as a safe haven. For the next event, the FOMC meeting minutes. This is not a data release, but rather a detailed record of the Federal Reserve latest meeting. So why it matters? Traders look for clues on future interest rate moves. If the tone was hawkish, which concern about inflation, market may anticipate rate hikes if dovish rate cuts might be expected. And for the next event is China CPI. The interpretation of this event is China is still in deflation, though slightly improved from last month. Weak consumer demand and economic slowdown are likely drivers. This may lead to more stimulus from Beijing. And the PPI, which reflects producer prices, fell more than expected. This signals that factory grade prices are under pressure, likely due to falling demand and global economic weakness. This is negative for industrial profits and can drag on recovery. For the China new loans event, a massive jump in new loans, possibly driven by government support or seasonal lending cycles. This suggests aggressive credit easing aiming to boost growth and consumption. For the following events, Helen, please help me with this.
Okay. For the next event, RBA Governor Bundespeaker, a high-impact speech from Australia's central bank has anything about the inflation rate high or economic concern can trigger big move on AUD traders should be alert for policy direction. The next event is core CPI. Core CPI excludes food and energy, it reflects underlying inflation. Alright, to the 0.3%, goods such as sticky inflation, possibility delaying rate cuts from the past. Then given the CPI, head of CPI is expected to grow, which could be a positive side. However, if the actual number is harder, market may price in a further tightening. Inflation is expected to come down on a yearly basis. A lower CPI could support the Fed rate cut narrative, but if it stays high, it could spook the markets and push jobs up. The negative unemployment claim. This weekly charted data give insight into the U.S. labor markets. A higher number suggests shortening employment, a weakened east wage ratio and inflation. A lower number might reflect concern of overhead labor markets. That's all about news for today.
Thank you, Raf and Helen, for the news calendar analysis. And this. Okay, so alright, that wraps up today's session on trading with WeMasterTrade. We covered a lot how platform works, the pros and cons, the risk management, and the strategies for success. And remember, trading is a journey, not a sprint. Stay disciplined and stick to your risk management plan, and keep learning. If you found this session helpful, be sure to like, subscribe, and follow for more content. And if you have any question or want to continue the discussion, drop them in the comments or join our community on Discord or Telegram. And at WeMasterTrade, we don't just give you a capital, we empower you with structure, strategy, and a community of traders who grow together. And our goal is simple: to help you scale, stay consistent, and trade like a pro, whether you're managing your first $10,000 funded account or aiming for six figures. If you're already a funded trader with us, stay focused and stick to your plan. And if you're still working to get funded, keep sharpening your skills. Your consistency is your edge. And don't forget to check WeMasterTrade calendar for upcoming bootcamps, mentorship calls, and community check-ins. And once again, thank you for showing up, and thank you for trading with intention, and thank you for being part of this powerful community. We're here to guide, support, and grow with you every step of the way. Until next time, trade smart, manage risk, and always remember, as WeMasterTrade, we don't just trade the market, we master it. Take care and see you in the next session.
Trade. copy trade. Copy trade. Copy trade. Trade. WeCopyTrade. Trade. Trade. WeMasterTrade.